Hi, welcome to this session where we'll break down a key financial metric, earnings yield. This powerful tool helps you evaluate a company's profitability in relation to its stock price, an essential insight for investors and finance professionals alike. Whether you're diving into your studies or applying this in real-world office scenarios, mastering earnings yield will sharpen your ability to assess stock value and make informed decisions. Let's dive in as we look at this fantastic issue and also explain briefly its calculation and implications. All right, I've gone mini as usual. Talking about the earnings yield is a financial metric that shows the percentage of a company's earnings relative to its share price. It is the inverse of the price-earning ratio and helps investors evaluate how much a company earns for every naira invested in its stock. Earnings yield is often used to compare the profitability of a stock with other investment options such as bonds and market averages. So the formula is clear. Earnings per share divided by the market price per share expressed as a percentage, where the earnings per share is the net profit on the bottom line divided by the number of outstanding shares calculated at the previous video, referred to them, while the market price per share is the current price of 1 unit of share of the company's stock. So let's calculate this very fast and quickly as we pick our earnings per share, which is 13 kobo, as you can see on the screen. And in the dividend yield, we use the market price per share, which we just pick graphically. And we have our earnings yield, very fast and simple, as 13 kobo divided by 5 naira. That is 3%, quite low. The dividend yield was about 6%, and we have the earn yield, further reduction to 3%. Okay, so what does this mean? What does this mean? The earnings yield indicate the return that shareholders would theoretically receive if the company distributed all its earnings as dividend. So theoretically means not the actual amount, but after the preferred dividend had been deducted from the net income on the bottom line, if 100% was distributed as dividend, how much the earnings yield in the market compared to the stock market price? That's graphically what this means. The higher earnings yield suggests a more attractive stock in terms of profitability compared to its market price, whereas a lower earnings yield implies the stock may be overvalued or less profitable. So in this case, you can see their profit, the company's profit or bottom line is low, culminating in a 3% comparison, the price of that same share in the market. So about 3% was what the earning, the dividend yielded in the market. What are the implications? A high earnings yield can signal that the stock is undervalued, offering high potential returns to investors. However, it can also indicate risk if earnings are expected to decline or if the stock price has fallen due to concerns. So these are very critical. So when you have a high earnings of about 50% and above, this could be the implication. While a low earnings, like we just saw, about 3%, might suggest the stock is overvalued or that the investors are paying a premium for future growth expectations. So this may be the case with the 3% earnings per share we just saw, and the cause and effect of high or a high earnings yield is stock price decline, strong earnings, or being in a mature industry with consistent profitability. These are the causes of the high earnings yield. While the effects is that it can attract value investors looking for undervalued stock, but could also indicate market skepticism about the company's future prospect. So investors that are looking for undervalued stock to take advantage of, especially when they know the market value of the shares in the market, take advantage of such, and that's the effect of a high earnings yield. While the causes of a low earnings yield are high stock price, low earnings, like we just saw in chapter 2, investor optimism about future growth, where investors are ready to plow back profits for expansion and growth, while the effects of a low earnings yield may appeal to growth-oriented investors, that's capital appreciation investors, but can deter those looking for immediate returns, that's the dividend-driven investors, based on current earnings. So in conclusion, earnings yield is an important measure for assessing the relative value of a stock or share in comparison to its earnings. It helps investors gauge whether a stock is attractively priced based on its profitability. A higher earnings yield can suggest a good buying opportunity, but it's important to evaluate it alongside other financial ratios and metrics to understand the full picture of the company's health and future prospects. So this ratio has to be compared with others, like we've seen about 6 different ratios: the dividend yield, the dividend cover, the dividends per share, the earnings per share, the dividend payout. So careful analysis of all these ratios should be sought out and evaluated to make informed decisions in the future prospects and also investment decisions. And this is where chartered accountants in training and finance professionals come in to help investors make informed decisions. This is very, very important. Okay, that's a wrap up on our deep dive into earnings yield, a vital metric for understanding stock value and profitability. Remember why a high yield might signal undervaluation, and a low yield could point to overvaluation. Always look at the big picture. As future finance leaders, mastering this concept is key to making informed strategic decisions. All right, if you find this video helpful, don't forget to like, subscribe, and hit the bell icon for more content that will keep you ahead in your professional journey. Don't forget, this is a wrap-up of our investment ratios. We've looked at about 6 or 7 of them. Don't forget to keep learning, keep growing, and I'll see you in the next video. Until next time, bye for now.